Welcome to Weekly Sense, everybody. Andrew Whalen here. There's a few things that happened this week that I want to really talk about. We're getting close to the end of the quarter, and it's been a pretty decent start for technology stocks to start the first quarter of this year. The S&P 500 has eked out a small gain. The Dow is basically flat, but technology has really had a resurgence to start this year. But what I really wanted to talk about with regards to looking at the fundamentals of what's going on, the mechanics under the hood, and something interesting to point out with what's going on within the NASDAQ comes really into this one chart. It's what's known as advanced declines. So the blue line is the NASDAQ. The red line is the advanced decline lines within the NASDAQ. So it basically shows you when the red line is declining, that shows you that more stocks in the NASDAQ are actually declining than advancing. So typically what you see in an upward market, you see the advanced decline line go up. But what you're seeing now is this huge dispergence. And what's really being caused by what's causing this is some of the leadership at the top. Think like Apple, Microsoft, NVIDIA, Tesla, who are big proponents of the NASDAQ, are really taking the market share and bringing the market higher. But if you look at the underpinnings or the underlying mechanics of the NASDAQ, a large majority of those stocks are actually hitting lows and going down further. So the underlying health of the market really isn't that healthy. Another thing, if we look at setting up into April, this yellow line is gold versus lumber. And it's something that we look at to kind of gauge directional shares of where the market may be going in the near term. And you can see, again, a huge dispergence of where equity prices are versus where some of these indicators are. Looks very similar to here, right? More stocks in the NASDAQ declining versus advancing, despite the NASDAQ being up so far this year. So typically you'll see it tends to track pretty closely. And what you're seeing now is this divergence. So one of two things will either happen. Earnings season kicks off in another couple of weeks. So either earnings are going to be really great and this advanced decline line corrects upwards and the market goes higher, or earnings will be subpar and this will continue to go down, bringing this line down. That's one of the two possibilities. New York Fed just came out with their probability of a recession. So they have these. You can see these on the Bloomberg terminal. And you can basically see it's now the highest probability of a recession going back to the 1980s. So again, not a healthy sign. You can see over here a 54% chance that within the next 12 months, we will be in a recession. You're also starting to see bank failures, bank collapses, also not a healthy sign of a growing economy. But yet the market is kind of shrugging a lot of these things off. Somebody who worked at Lehman Brothers built a model. He said it crashed within the next 60 days. I don't want to put too much validity into that. He did work at Lehman Brothers, but he's a very smart person, has built a risk model that calls for that. And we've been talking about this for quite some time about how much risk is in the portfolio, how much risk are you taking in your portfolio, and just to be mindful when you start to get closer to the potential end of a business cycle. But let's just assume, let's have fun for just a moment. And let's assume that October was the low of this market. So last October. So if October 2022 was the low, it would be the first end to a bear market in history without the Federal Reserve cutting interest rates. It would be the first end of a bear market in history without the unemployment rate increasing by at least 0.5%. It would be the first end of a bear market in history with no peak in jobless claims. It would be the first end to a bear market in history without the yield curve uninverting. It would be the first end to a bear market in history without a significant decrease in corporate earnings. And lastly, it would be the first end to a bear market in history without inflation below 4%. So that's a lot of first ifs in that scenario. So doesn't mean that it can't happen, just means that we should probably be more mindful about where we're taking risk and what we're seeing in the market. And the last thing that I wanted to share for Weekly Sense this week is, our opinion that a recession is more than likely coming and to be prepared, right? We had $5.5 trillion of government stimulus and a little over $4.5 trillion in federal balance sheet expansion post-COVID. US GDP of $20.5 trillion, so 50% of GDP in stimulus since COVID. That drove the best GDP growth in 40 years in 2021. Now the Fed is forced to tighten due to high inflation while demand starts to slow, much similar to the 1970s. With 35% of households do not own their own homes, 45% do not own stocks, those people are hurt by inflation. But the Fed is in this conundrum of, do we raise rates? Do we not raise rates? Because if we continue to raise rates, it's going to put more pressure on the banking system. But if we don't raise rates and we go through this door, then inflation is going to remain stubbornly high. So the Fed really has its work cut out for it. But since World War II, inflation, CPI, over 5% has preceded a recession every single time. Also, since World War II, 10 of the last 13 prior recessions have been preceded by a tightening cycle by the Fed, raising rates. 10 of the last 13 recessions since World War II have been preceded by the 10-year Treasury yield going below the 2-year Treasury yield. And since the 1970s, anytime oil prices have doubled relative to their 2-year average, in this case, about $54 a barrel, that has preceded a recession. So each one of those metrics by themselves alone has a great track record in predicting a recession, but this time, all of them have occurred. So this notion, again, that we have the opportunity to go through a soft landing is getting smaller and smaller, specifically as inflation stays stickier and stickier. So we do have something of somewhat of a tailwind behind us. There's still $2.5 trillion there was excess savings of $2.5 trillion at the peak by U.S. consumers. From our calculations, we think that could be gone by late 2023. And there's some long-term deflationary tailwinds that have now switched to more inflationary headwinds. So onshoring, right? Bringing things back into the United States. Well, it costs a lot more money to make things here than it does overseas. That's inflationary. Slowing population growth. That's inflationary, right? The older you get, the less you tend to spend versus younger generations. ESG is inflationary because of the cost to follow those policies. Energy security, making sure that we're developing more energy here versus relying on outsourcing and bringing it in. And this huge historical capacity of underinvestment in the energy sector that we've seen over the last 2 to 2.5 years can be extremely inflationary, or at least a headwind in inflation over the next year or so, that forces the Fed to potentially raise rates higher, even though they're facing potential cracks in the financial system. So we think that slowdown in consumer demand in 2022 leads to a slowdown in enterprise demand this year. And the strong labor market that we currently have may cushion some of the downside. Remember, we've got 5 million more jobs than unemployed. That may be a little bit of a cushioning, but we expect a recession as financial conditions continue to tighten and services and commodity inflation still remains, relatively high based off of everything that we said. So all of those things, come to a point of, how do you dictate and build portfolios? Obviously, that is up to the amount of risk that, everybody is willing to take. But, we just want to be in a position where we're being a little bit more cautious versus being optimistic when you have all of these things that could potentially be working against you. So we get a little bit more inflation news next week. We got some of the jobless claim news this week came in, relatively okay. And then starting in April, we kick off earnings season. So that's when a lot of the hard work goes into place. So everybody have a great week. Happy Weekly Sense.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Wayland Financial may maintain positions in the securities discussed in this podcast.